Good afternoon, everyone. So, our next panel will consist of Mr. Nirav Choksi, co founder and CEO, Credible, who will be moderating our panel, Mr. Mukesh Bubna, Chief Executive Officer, Monexo Fintech Private Limited, Gaurav Jalan, founder and CEO, Empocket, and Mr. Rohit Garg, co founder and CEO, Smartcoin. Our panel discussion topic will be opportunities for fintech in the post COVID world. Now over to you, Mr. Nirav, for moderating the session.
Great. Thank you, Aman. Good afternoon, everyone. My name is Nirav Choksi, and I'm the co-founder and CEO of Credible. Credible quickly is a trade finance fintech platform enabling large-scale liquidity programs for vendor, dealer, distributor ecosystems of large corporates, and in partnership with large financial institutions. We have a great discussion lined up today for you as we deliberate on opportunities for fintech in the post-COVID world. We have probably witnessed one of the most hard-hitting black swan events in recent history over the last 12 months. COVID, as we know, has completely changed the rules for business, especially for fintechs and financial institutions. With the Indian GDP shrinking more than 20%, corporate India has been hit really hard, but the hardest hit are the MSME ecosystem and consumer confidence. While the budget did nothing really to directly boost consumer spending, there are rays of hope around the corner. So, for example, with increased infrastructure spending and subsequent employment opportunities, we expect consumer demand to resurface stronger. And this in turn would drive digital payments and credit. And again, this is where fintechs would play a major role. Also, pent-up demand would further drive consumer spending and hence credit primarily for consumer finance companies, and this would be positively affected for that sector. Also, finally, with the vaccine round the corner, certainly it looks like there will be an acceleration of return to normalcy. With that happening, travel, hospitality is expected to open up in its full glory again. And this in turn would lead to events, weddings, etc., which would drive demand for personal loans higher. So I'm very, very fortunate to be joined by an elite panel of fintech CEOs and founders. And the idea today is to talk about these opportunities and explore others in the post-COVID world. So I would request the panel to briefly introduce themselves and then share with us what opportunities they see emerging in the post-COVID world. Rohit, would you like to start?
Yeah, sure. For hosting me. So to give a quick introduction, we run a startup called Spotcoin. We are into fintech consumer lending. And what we do, we actually enable access to credit for what we call as the emerging India, which consists of 30, 40 crore odd people who are working as micro entrepreneurs, small shopkeepers, blue-gray collared workforce, which is working as delivery boys, drivers, guards. So essentially the middle lower income mass market of India, who have traditionally been not served by the banks and NBFCs. And we provide credit to them, microcredit to them from as low as 1,000 rupees going up to 50,000 rupees in a 100% digital and automated manner. And so far, we have served over 5 million users across the length and breadth of India. So proud to say that we have customers across all the states and more than 95% districts. So as far as Arunachal Pradesh, Jammu Kashmir, and even Andaman and Nicobar, we have served people through the power of digital India. I'm happy to, I think, share more thoughts around how we, look at the opportunities in the post-COVID world. I think post the intros.
Great, thank you, Rohit. Gaurav, would you like to go next?
Sure. Thank you, Nirav. So I am the founder and CEO of Empocket. Empocket is a mobile-based consumer lending application. We've now been serving customers for more than 4 years, and we primarily provide small ticket loans to customers that are basically not served by traditional NBFCs and banks, right? So our target segments primarily are college students and young working professionals. Those are the two segments that we currently target, and we will continue kind of expanding our customer base and targeting more people who need access to credit. So over these last few years, we've served over kind of close to 15 lakh KYC approved borrowers, and I think again we'll talk more about this in detail during the discussion. But I think all of us, and even as an industry, we're at the very early stages in terms of penetration. So I think there's a lot more consumers out there that need services like ours. So hoping to discuss that more. Thank you.
Great. Thank you, Gaurav. Mukesh?
Thank you, Nirav. Uh, while our segments kind of overlap somewhere between Gaurav and Smartcoin or any other lender, but the key differentiation which we are with is we're not a balance sheet lender. We are a licensed NBFC peer-to-peer lending company, among the first few to get license in India. We are pioneering an industry which we believe will emerge as the next mutual fund of India, where everybody in their asset allocation will have 5 to 10% of allocation towards peer-to-peer lending asset class. And that's what our hope is. And we're looking to build out $1 billion book in the next 4 or 5 years.
Excellent. Great. Thank you, Mukesh. Let's talk about the post-COVID world, right? There were several opportunities prior to COVID, and we were all trying to capitalize on those opportunities. How do you see this change, in a post-COVID world? What new opportunities are you seeing today, and what opportunities do you think will continue to grow? Let's start with Gaurav on this, and then we'll move across the panel.
So I think what we have seen, the opportunity set has not changed much, right? Because the opportunity set is basically the people who are not being served by banks and NBFCs. I mean, we know that there are only about 3 crore people who have credit cards in this country, right? And again, the standards for banks to give out personal loans are extremely tight. And a very vast majority of the country does not qualify for any kind of credit. So I think that underlying demand has not changed from pre-COVID to post-COVID. If anything, I think the disruption that COVID brought about actually exacerbated cash flow stress for a lot of people, and so demand actually went up for personal credit. Right. So I think what has changed is the approach that I think we are taking in terms of identifying who we can give out credit to. Right. So obviously, all of us work with underwriting models that we've built to serve our user base. So I think the main challenge that COVID has thrown up is how do you now modify these models given the kind of very sharp increase in delinquencies, etc., that came about during COVID. And I think at least what we are seeing is that there is still a bit of trailing effect of that, right? So we haven't gone back completely to where we were pre-COVID in terms of in terms of just borrower behavior, I would put it broadly, right? So I think that's the key challenge. It's not that the demand set has changed, but it's about how do we best address that demand and how do we tweak our approach to identify the right borrowers.
So the nature of the opportunity is probably changed, but the opportunity to serve underserved credit it still exists. If I understand that right. Rohit, Rohit, you are in a similar space. What are your thoughts around this one?
Right, Nirav. So I think I look at it, I think from 2-3 different lenses, right? So one is I think the data angle. So I think as Gaurav also pointed out, right? I mean, we because we're focusing on the underserved, right? I mean, segments might differ, but the problem is obviously there. And I think what we realize, banks and NBFCs find it tough to serve them. Among other reasons, the biggest reason is obviously because lack of traditional underwriting data, right? These guys don't have thick bureau scores, they don't have traditional pay slips, bank statements, right? So one great thing I think that has happened post the pandemic is now because of that huge digital push, right? I mean, whatever was supposed to happen in a decade has happened in months, right? So now even people in the remotest corners of the country, or even among the lowest income segments, they are now generating a lot of digital footprints. So companies like ours who actually leverage a lot of this digital data to underwrite them and serve them, they obviously are hugely benefited in that sense, right? So now an average kirana shopkeeper in a tier 4 city, he's also generating significant data as compared to a urban metro based shopkeeper. So now it becomes actually possible to look at their profiles and extend credit in far more better manner, right? So that
Right.
is one angle, which has obviously, I think, really happened quite positively. Second angle is, like, while digital India has obviously been growing over the last few years, again this push has brought a lot of financial awareness. So I think there is a better demand, I think, from customer themselves who actually want better control of their financial lives, right? So pandemic has shown the importance of the right financial planning. How do you, I think, look at your financial portfolio and think about it? I think that has become far more important than earlier, right? Especially for the relatively younger demographic, right, which hadn't seen a crisis of this scale, right? I mean, in the recent past. So now I think people are looking for the right avenues and to enable those products, because again now the needs again get very different. So platforms which are leveraging data to create the right personalized data driven product for these customers, whether it's in lending or other related areas, they will obviously receive a huge boost. So I think that's where I think the opportunity and awareness has grown a lot. And the third angle where we see, again, I think a lot of work which needs to be done more than ever. I think with things like moratorium, while a lot of people were trying to explain what exactly this is, we still discovered, for the average customer, it was very difficult. Like more than half of our customer base initially thought it's a loan waiver, right? So how do you really
Right.
go about educating these guys? Because I mean, India is in a very interesting position, right? I mean, most of the guys are young now; they're more aware, they are more connected. But how do you simplify and build on the trust, that engagement that, say, fintech platforms will have vis-a-vis traditional institutions, to build that, which effectively becomes a huge boost for the entire ecosystem. So that's where also a lot of work needs to be done, and people are more receptive to that now. So I think companies which can actually work on alternate data, deeply engaging products and financial awareness in the right manner, I think the opportunity pool has expanded in that manner.
No, I absolutely agree. I think with digitalization growing at the pace it is, and COVID accelerated that growth, I think the opportunity to underwrite using non-traditional data becomes even more interesting. Mukesh, how are investors, your investors looking at opportunities especially peer-to-peer lending investors? I think you're on mute, Mukesh.
Surprisingly, the interest from the lenders or the investors have been very high post-COVID, uh, primarily because of a couple of reasons. One is the fact that they saw this product still giving us high low single digit to a high double digit returns during COVID time, right? Because
Right.
we have a product called monthly income plan where customers do get their interest month on month. So even during COVID time, they were getting 11.5% return on their investment, even though we had given moratorium to a decent size of a portfolio. Second is they saw the market has gone up, rallied quite a bit between April to October already. So they're now saying, I booked the profit, where do I put it in? The only other avenue they can put it back is mutual fund or equity again. So they're saying, I booked a profit, where do I put it in? And the third is the confidence they have gained over a period of time by working with us. uh, and they are seeing that we have been able to perform during the toughest time, right? If I may say, we are an open kitchen,
Sure.
right? Everybody sees what we do, and
Right.
everybody has an opinion. How should we do it, right? So in that aspect, all these three has helped us to bring back our old lenders, as well as we work with a lot of wealth managers. They are also very receptive to this product now because they want to add with the confusion around SEBI, RIA, SEBI defining how much they can charge, all that changes which are happening, they're trying to find a new product which they can take to their clients. Otherwise, they're not differentiated enough. If all of
Right.
us went to a wealth manager, they're giving us the same three products. So any smart wealth manager is surely saying, how do I differentiate myself? And that's also helping us.
Got it. No, great. Let's move on to the uniqueness of fintechs versus financial institutions today. How do you think fintechs are leveraging their assets, data, the technology platforms, and the uniqueness that they bring to the table to seize new opportunities beyond COVID? Uh, Rohit, you want to extend your thoughts on the first point that you made?
Sure. So, like when we started, working with our segment almost 4 years back now, uh, like we talked to, more than 400, 500 people, working as small shopkeepers, self-employed contractors, plumbers, drivers, delivery boys, all these sort of people, right? And we realized while there were multiple gap areas, I think the key ones came from a few places. One, as I said, obviously is on the underwriting side because that becomes a cash-22 situation. If you don't have a score, you can't get a loan. If you can't get a loan, you cannot build a score, right? So, and because traditional institutions do not ever look beyond out, or they don't have the bandwidth as well, right? So I think it becomes very difficult.
Right.
Second thing which we again realized was around the kind of product that are suitable for different segments. So, like when it's concerned, with people like you and me, obviously high ticket personal loan, for instance, if I take one on the unsecured side, that makes sense, right? Because you have enough saving cushion. You typically need credit when there's a big event happening in the family, or you want to buy something out. But other than that, you are well covered. When you look at smaller income segments, people who are earning say between 10,000 to 30, 40,000 rupees a month, they don't obviously have a lot of this cushion, and so
Right.
they have periodic cyclical shocks. So for them, it becomes important to get access to small size or sachet size products, but on a more frequent basis. And again, if banks, because they typically underwrite in a manual manner, there are branches involved, it becomes almost impossible for them to make that available. So in order to do that, you need a completely tech-enabled product which can still make it sustainable. So coming from those sides, I think we figured a fintech which can actually work in a 100% digital manner, thereby reducing, say, the cost of operations and making microcredit sustainable. That is obviously going to be one of the primary requirements. Number two is how do you go beyond the traditional data and figure how do you work around that the new born sources of data to provide credit is important. Again, the problem there was because all of this, I think, huge digital uptake has happened say largely in the past 5 6 years. There's not a lot of precedent around it. Even if you start consuming that data, what is right, what is not, how does it matter, across different segments? Because India in itself is a huge continent, right? The credit behavior changes in so many ways across income, across geographies, across work profiles. So one model will not fit all of them. So how do you create the right level of say machine learning based algorithms which can actually account for these peculiar characteristic of different segments to serve them correctly? That becomes very, very important. And I think thirdly, while I think digital education has, I think, grown leap and bounds, still, like when it comes to money matters, building trust is very, very important. So, how do you build your platform in such a way that I think customers are able to build that trust and I think come to you whenever they are in a financial problem, right? Or maybe even before that, ideally. So, I think building technology in order to I think build the right channels for communication, deal with I think these inherent problems that were there. I think that was very important, and I think that is what I think we have focused on from the beginning. So I believe I think if still like leveraging technology is obviously a must, but again how you do it will obviously depend on the nuances of your segment and what the problems they are dealing with, and that becomes very key.
Great. Understood. Gaurav, taking off from what Rohit said, do you see one of the uniqueness of fintechs? Their ability to redefine how credit is defined to start with.
I think absolutely. So, I mean, Rohit, leveraging technology or for the underwriting. I mean, he described that. I think the other place where broadly technology, where it comes into play is the overall user experience, right? So it's not just it's how the user finds out about your product. it is how they are able to explore your product to actually understand whether it will be useful for them or not. Then it is the onboarding process. So if they choose to use your product, what is the onboarding process you take them through? And then it is the delivery of the credit, and finally also obviously the taking the repayments, right? So that is the entire user journey. So I think every aspect of that, I think technology plays a very, very important role, right?
Right.
Right from how do you identify the right customers to how do you actually design the product to make it useful to your customer. And again, the same customer may go to two different fintech platforms for different type of loan needs, right? So there may be a particular platform that works well if you want to borrow a small amount for a short period of time, whereas if you want to borrow a slightly larger amount and you want to pay it over a year or 2 years, then there might be another platform that works better, right? So I think that communication with the user and managing that experience is something that I think through COVID we've also realized is very, very important, right? Because how do you engage with the customer? How do you actually clarify things? How do you communicate things? There's also a lot of misinformation in the market, right?
Sure.
So a lot of people expect that just because they've come and they've uploaded some documents, they should be able to borrow, for example. But it's, I mean, for most of us, it doesn't work like that, right? There is some process that we have behind that as well, to
Sure.
decide whether you can borrow or not. So I think these are the aspects. The overall, how do we kind of make the overall user experience of fintech better? How do we communicate with them better? And I think that is eventually what will lead to higher penetration and customers trusting fintechs to meet their credit needs.
Right. Mukesh, just to take off on the trust issue, right? For a non-balance sheet lender, the customer experience and the trust that they can, show on your platform becomes your largest asset. Um, how are you managing that, and what are the operational challenges there?
Uh, from day one, we've been very, very transparent. And I think your question is more towards the lender than the borrower. Borrower is looking for money, and as long as you give him fast service, give him a amount which he's looking for, and you are giving him a reasonable interest rate compared to everybody else, he's okay, right? But the lenders are the one which require a lot of trust because they're putting their money at risk on your name or your brand name. And currently, I would say we are still building our brand. We are like what mutual fund would be in 1990s, if I may use that word.
Sure.
So for customers, we started doing few things regularly. One, we said, hey, you can see your portfolio at a glance every day. What we have collected, what we have not collected, who's defaulting, completely transparently at each unit level. Second, we dealt with is by diversification. So let me delve into this diversification a little more. First, we said you can bring as high as 3 lakh rupees, but you can spread that across 5,000 borrowers. As little as 1,000 rupees per borrower. So you are not taking the full risk of the loan, but you're taking 1,000, the unit of the loan. If the loan is for 50,000 rupees, there's 50 units to be bought. With this diversification, your capital is more or less not going to be lost ever because you are earning 18 to 20% interest rate. Third, we showed them the power of compounding through models. Fourth, we gave them an opportunity to exit anytime through our secondary market. So consumers can buy and sell loans on our platform within themselves. Just like a mutual fund, if you want an exit, you can get an exit. And the fifth is our monthly income plan. As long as they see their monthly income coming back, and that's at a certain threshold, they feel very confident that we are doing our job.
Oh, great. That sounds super. Let's move on to the investor community beyond lenders on platforms. But let's also probably touch upon co-lending partners. How are investors, especially co-lending partners, looking at the fintech space today and the opportunities therein, say banks and other financial institutions? Rohit?
Sure, Nirav. So I think things have changed. I think overall in a positive manner, especially post-pandemic, because large institutions are also realizing that now I think they need to adapt faster than ever, they ever thought. So co-lending has been generally growing and there has been a higher acceptance. However, obviously, because there is a big difference in terms of how, say, the banks and fintechs are designed in terms of regulation, compliance, customer communication. So I think things have been slow to, change. But I think with pandemic, I think, banks are also realizing that uh, upskilling or, adoption of technology is going to take time and they cannot change everything overnight. So I think they're far more open to, I think figuring complementary skill sets that I think fintechs can bring in and leverage, I think, their benefit along with whatever advantages banks bring in terms of, access to customers and a large capital basis and trust. And like if we can marry the two in the right manner, then obviously it creates a win-win situation for both. So I think we have seen much more, I think positive conversations happening with larger banks. In fact, in certain cases, we have seen a lot of inbound interest as well, wherein they're looking for people, I'd say targeting the underserved segments which they traditionally don't go after, right?
Right.
So that ends up creating, I think, complementary value as well. Another thing which I think is also helping there, like I believe even before the pandemic, over the last, I think, 17, 18 months, ever since ILFS happened, the fintech lending sector has been, battling maybe certain sort of, not crisis, but at least problematic situations. So fintechs, which have now been able to, I think, prove themselves and, grow in a sustainable manner over this period. So that also gives a lot of confidence to these large institutions that, like these institutions are, or these fintechs are here for the long run and not just, trying to do something hunky-dory which we don't understand. So I think that is also now giving a lot of credibility when I think we are talking to large banks. So I think this is something where we should, I think, a lot more action happening in the near future.
Good, got it. Mukesh, we spoke about HNI investors on the platform and their level of trust and comfort, etc. How about organized institutions like NBFCs and banks? How are they looking at the entire peer-to-peer space?
So they are quite interested, but RBI has put a cap currently that any kind of person cannot invest more than 50 lakh on a peer-to-peer lending platform. So for us,
Right.
our real flow of funds is from retail investors and HNI investors.
Right.
We, as a peer-to-peer lending association, are lobbying with the government and RBI to remove that cap and give us a level playing field. And specifically, what has happened recently with the digital lending and the Chinese companies, which were literally coming down and lending at a very high interest rate and using somebody else's NBFC balance sheet, uh, we have been looked into a very positive light because they were quasi or sometimes not even governed, while we are governed. So we are
Right.
very hopeful that that limit will go away in this year, and then the flow of money from institutions, NBFC will start moving towards us also.
Right. Understood. Gaurav, when you talk about underserved or new to credit customers, which traditionally banks and NBFCs have stayed away from, and now they, come back and want to partner with fintech companies such as yourself. How are they looking at these credit models differently today, and why?
So I think there is still a fundamental kind of mismatch in approach when it comes to, I think, what we do as fintechs and how traditional NBFCs and banks approach underwriting, right? Because traditionally underwriting has been the dashboard kind of approach, right? Like you have check boxes, and if you meet XYZ criteria, based on that, you will be lent a certain amount of money. Now, a lot of the models that we work with, because we work with alternate data, these are not necessarily explainable models, right? So to that extent, I think thinking needs to evolve. It is evolving, but it's not there yet. Where let's say a bank will need to get comfortable saying that, okay, I'm not going to worry about explaining the model, but rather I'm going to look at the results of the model, and based on that, I'm going to evaluate and then build a relationship. So I think that is still some time away in my view, Nirav. I mean, the discussions are there, but I don't think banks are there yet where they will be able to kind of be willing to deploy large scale funds. I mean, obviously, pilot programs, etc., could happen, but I think we're still a little while away from that.
So is there a lot of insistence on things like an FLDG or a or a first loss, some sort of a first loss guarantee from banks to be able to even consider participating on platforms like this today?
At least that's what we've seen. I think it's very much part of the discussion currently, and I think that possibly only goes away once the banks start trusting the credibility of the models and the history of the data more. Right, that is when I think they'll be willing to forego that comfort that comes with an FLDG.
Understood. Rohit, how long do you think it'll take for these models to fully evolve and be reach a point of comfort where investors can look at it and say, okay, this is predictable credit behavior?
Right. So I think, see, there are a couple of things to it, right? One is you create a model and then you obviously show that the model works. So one thing is about the model building process itself, right? So I think that's obviously getting better over time with access to cloud and I think better machine learning technologies. So it comes down to how good your data sets are. So I believe from the technology side, I think we are in a pretty good place. But the key thing is one, I think what sort of customer base are you going for? So in our case, because we're going after, sort of the very sort of massive market where I think traditionally also, most guys have not served even in an offline manner. So the data sets become very limited. So you have to, one, I think, gather those data sets in a very unbiased manner and then build your model. That is the first thing. Now, once you have done it, then you have to actually show the performance. And that depends on the products that you are doing. So if you are, say, doing a 2-year loan versus, say, a 6-month loan, again, to show a few vintage cycles for a 2-year loan, that itself will, again, magnify in that sense. So how do you choose that right mix? That becomes very important. In all, I think we believe that anywhere between, I think, 2 to 3 years, at least for a company which is, initially starting up, I think that is the time that you will need to show proper efficacy of your models. I think obviously once you have done it, then I think the confidence builds up in the building blocks at least. So now on incremental data, I think the time starts to get lower and lower. Even after you do all of this, I think there is one question which has always remained, right? So whenever we used to talk to all these large institutions, whether on the lender side or even I think general investor side, uh, one obvious comment always was that you have not seen a down cycle, and obviously lending is a cyclical business, right? So you have started in the credit boom era, and we don't know how it's gonna be. So I think that is a question that was always posed, and that's not something that you can artificially create either. As I said, because data sets are new. So that's
COVID has helped.
right. So exactly. I think so. COVID was a blessing in disguise because now I think what we can say is that we have seen a downturn and like one of the biggest of them all, right? So companies which are now able to come out unscathed or like with much solid learnings out of it. So now their credibility has gone up substantially. So I think that is something which will now I think help to I think accelerate that sort of acceptance around this. Because I think another thing that you would have noticed, right, in the last 5-6 years, pretty much every lending company that began, everyone said that we are using AI and machine learning, and that became sort of over abused, right? And for an investor, obviously, it's very difficult to figure what is actually AI and what is not. So again, I think these sort of down cycles actually give a lot more credibility. So I think things are actually going in the right direction now.
No, I completely agree. Mukesh, you were smiling when I asked the question, so I'd love to hear your thoughts.
No, no, Rohit answered. Again, I've been a banker for 20, 25 years, and across Southeast Asia, I've seen 14 geographies. And we used to see any three geographies having a credit crisis at any given point of time. So we used to say we have 13 children, and 2 or 3 children are sick at any given point of time. And I'm sick means there is some cycle going on in that market. Uh, we treat India, and Rohit alluded to it, that by segment, by geography, consumers behave differently. Even if you are not a great understanding of credit in India, but we all know North India behaves the worst. It doesn't require any more data right now. It's been proven way back when I joined the banking industry, early 90s, and we had today in 2020. That hasn't changed. Now, India has to be treated differently.
Sure.
Each state, each geography is very different, and as you said, the model can only be trained if you have a lot of data and you have right set of data, right? You believe uh, there are 500 parameters which go into, but at the end of it, there are 3 or 4 or 10 or 20 which will risk rank. The remaining 400 is all gas. People who say on their website that you're using 700 data points to make an algorithm, that sentence itself tells you that they don't know what they're talking about.
But I'm glad you said it. I didn't, but I tend to agree with you. Uh, let's move on to equity investors, right? How are equity investors looking at both non-digital lenders and platform businesses and digital lenders? So Mukesh, let's start with you. Being a platform, uh, where do you see investor interest moving towards?
So I think till now, the interest had been to this whole digital lending not be under the regulators, right? Equity investors want no regulators at all, right? But it's not going to happen forever. Uber got regulated,
Sure.
Ola is getting into regulation. So I think the party's over for them. And that's why we hadn't seen much interest on peer-to-peer lending because we were regulated and we were heavy-handedly regulated till now. Just before COVID, we got into this band of 10 lakh per lender going to 50 lakh. Unfortunately, we could not cash in on that because that happened in January, and by March 14th, the whole country came to a standstill, right? But we are
Right.
seeing that growth come through to the peer-to-peer lending. Uh, and as they see that retail investors are the most sticky ones, institutional lender can decide, I'm not giving you the 100 crore overdraft anymore. Sorry, you've withdrawn 40, I'm stopping the 60 crores, and suddenly your company plan changes. While ours is slow growth, but as we see today in mutual fund, SIP gives 8,000 crore per month. Whether the market is going up or market is going down, that number doesn't change. And that's roughly $1 billion a month coming from saving accounts to mutual fund. That's my dream, to create that kind of a momentum and democratizing finance in India. No need for bank, no need for anybody. Just come, everybody's a banker. You can be a banker with 5,000 loans. And as we know, 5,000 loans, you will never lose your capital.
Excellent. Great. Rohit, what metrics are you seeing? Sorry, I've asked you now. Let's go to Gaurav first. Gaurav, what metrics are you seeing investors, you know, getting attracted to? Equity investors primarily.
So I think what we see a fair amount of interest from equity investors. I think the overall recognition that there's a very large opportunity is there, right? So I think what investors are trying to figure out is which are the right kind of business models that will succeed in this environment, right? Because I think, as Mukesh also pointed out, increasing regulation is an inevitability. I mean, anyway, lending was always a very regulated business. I mean, I think there was a little bit of a gray space in which some digital lenders were operating, but over time, I mean, this business is always going to be regulated. It's that this is the case everywhere in the world. It's going to remain the case in India. So I think an investor is mostly interested in is which are the companies that can actually have a product that customers want and have a business that can remain compliant and yet has potential for significant scale. Right? As you think that's what they're trying to figure out. And I think the data points that they look at are kind of, I would imagine the standard data points any lender would look at, right? Which is like, how are your cohorts behaving? What is your cost structure? How do you actually, what is, how have your underwriting models worked? How are you going to fund your growth, etc. Right? So I think those are kind of the standard parameters. But so I think there is interest, but I think right now there is a little bit of investors are still waiting to see how the space evolves a little bit, because I think there is, it's been ongoing. There has been some consolidation, and I think it's going to continue, where some players are going to emerge stronger out of this entire throughout this entire COVID period, and the subsequent regulatory changes. So I think investors probably want to wait to see which are those horses that they can back, right? So, but I think overall interest is there, and I expect that once the regulatory kind of framework becomes more certain, there will be a big amount of capital that will get deployed over a short period of time, right? Because again, we are a capital hungry industry, right? I mean, lending capital is our raw material, so there's no way you can get away from that.
And especially when banks don't lend today, and very few NBFCs are looking at lending to digital lenders. So that becomes even equity becomes the mainstay, right? Rohit, you touched upon data being the ability for fintechs to capture data from their customers. How are investors looking at that? That entire piece and the future opportunities that this data may present going forward.
Right. So I think, see, one thing which I particularly believe, right, and I think it's also becoming clear is that unlike I think West, if I may say, right, uh, Indian fintech sector has to do a lot more in order to bring real value for the customer. Like I think the banks here are even NBFCs are so agile and so tech focused that it's not it couldn't be just a convenience play, right? That we'll give the same thing, but because we're a startup, we'll do it better, and so people will come to us. And that is I think something we have seen over the last few years. And that's where I think like you asked about what the investor interest is and how they look at data. So I think that's where like how you're building your core USP, whether it's around your segment and what you're offering, that becomes very, very important. And within that itself, I think data obviously plays a huge role, because I think without that, I think there is, I mean, you can add some value, but now whether that counters for all the other frictions that you have in terms of higher cost of capital and all other things that are there, I think that does not actually equate. So I think coming to the data bit, I think investors do understand that data is going to be the prime differentiator for any startup to really build, like sort of a huge book in this market and have a defensibility advantage. The key question obviously comes down to what sort of data you are using, whether that is proprietary data or generic data. Uh, what are the things that you can build out of that data, which again differentiate you from the rest? As I think said earlier as well, right? I think using AI/ML, getting access to all sort of data, I think that is actually pretty easy in today's world. But then how you are really processing it to really create something meaningful out of it, how do you prove that? That becomes very, very important. So I think the data story will remain intact, but exactly how do you use this data will become more and more important. Another thing which I think will also become important, like in general, we talked about regulation and governance, and that will, I think, touch on the data side as well. Because now obviously there is growing concern around data privacy and how you're using data, how you are managing it. I mean, like how does it impact the customer apart from your product itself? So I think there is also going to be growing concern around that. So again, like how you're proactively addressing that as a company when you're interacting with the customer or otherwise, I think that will also gain more steam. So I think so I think like apart from the usual growth stats or the growth metrics, your focus on governance and regulation and how you are adequately covered or planning for it, I think that's going to be one of the key differentiators for equity investors.
Right. No, also, I mean, when I talk to investors and we talk about data, especially in the SME segment or the vendor, dealer, distributor segment, a lot of it comes down to how are you effectively using that data to grow your wallet share, right? So you're now sitting with billing history, you're sitting with bank statements, you're sitting with credit assessments of all these guys, and then uh, while you're doing a corporate-led supply chain financing program for them, are you able to then create new lending opportunities to that same set? And the more you can prove that, and obviously the more numbers you have, the more resilient your platform becomes and the more defensible it becomes, like you rightly said. And I think that's something that creates a lot of value. So for all of us fintechs, I think the new gold mine is the data that we are capturing.
Correct.
Today we probably have one monetizable opportunity, which may be digital lending, which may be peer-to-peer lending, which may be insurance or anything else. But then with that data, eventually you can go out there and create this financial services super hub, so to speak, where
Correct.
you can then monetize it.
No, and in fact, I think just to add one more point, I think on top of it, right? So again, lending typically was relatively very transactional in nature, right? Historically, bank gives you a loan, and as long as you're paying on time, you really don't need to interact with them again. So I think with, again, fintech platforms like all of us, you obviously build a deeper relationship with the customer. The deeper you are able to build, more data you are able to get. And if you basically
Right.
take through the value chain, offering more products, you get better quality data, right? Which helps you to basically feed that virtuous cycle. So I think that
Sure.
is also something which obviously then shows up in all of your metrics, whether it's retention, whether it's your average CAC and everything else, right? So, I mean, you're right. I mean, that definitely adds up in terms of how you're using.
Look,
I
this
see it
has
slightly
been.
differently.
Sorry, go ahead, Mukesh.
Uh, See this whole thing around neo banks, right? We've seen what Monzo is going through. Few already have given up this whole process now, right? So this whole concept around let's go acquire data and we'll figure out monetization, kind of a WhatsApp model. And we saw what happened with WhatsApp the moment it said, I'm going to change privacy. Companies which have never heard of, people said, I'll go to Telegram, I'll go to Signal. They stayed back and eventually, but acquiring just data for the sake of data and then thinking of monetization, yet to be proven. We've seen
No,
many
absolutely.
examples of companies doing it, but I think fintechs who start from lending and then grow into other products because they have a ability to generate revenue from day one versus just keep putting money from equity investors and then figure out how eventually to figure out by that time maybe the customer has already sailed. He's maybe using for good UX UI, but he's not really looking you for a product anymore.
No, I can't agree with you more. I mean, what I meant to say was that you're already in a monetized line of business, right? So we are already lending, in my case, to probably SME, MSME communities, Rohit and Gaurav, in your case, to the consumer segment. But and in the process of lending, you are gathering a lot of data. So the game, the future opportunity, the way I look at it, potentially is what more can you do with that data? And in my experience, equity investors are also very keen to understand, your story about that. And it's clearly linked to monetization. It's clearly linked to a clear vision of how are you going to monetize that data, without kind of stepping beyond regulation, etc. So I agree with you absolutely, Mukesh. I don't think a WhatsApp model for a fintech company makes any sense. Although a lot of them do get funded and funded really well, but I think sustainably, uh, one needs to think of monetization. Look, guys, this has been a phenomenal discussion, and I can't thank you enough. But what I'd like to do before we wrap up is, invite you to give me a kind of a 2 minute closing on your thoughts around future opportunities for fintechs and whatever you want to say about that. So, Mukesh, if you'd like to go first, and then maybe Gaurav, then Rohit, and then we can wrap it up.
Uh, I look at macro for India. I've never seen a forward-looking statements made by government and followed by action by RBI. Uh, Without getting into politics, but we've been talking about digital India and we're seeing it happening through UPI, NPCI, Aadhaar, JAM, whatever. So that's fantastic. India is the one of the youngest democracy. Second point, right? So I was born with rotatory phones, but this generation is born with a smartphone, right? Uh, and India is still credit starved, right? I've been doing a lot of work on the rural area recently. It is completely starved and underserved in lots of pockets. Customers are waiting for 20 days to get a response from a bank. And all these three are a right combination to disrupt the incumbents currently, uh, and evolve the model further.
Super. Gaurav?
So, as Mukesh mentioned and we've discussed, I mean, the opportunity is obviously huge. I think what is really important for, every company to figure out in its own way is, which segment or segments are you going to go after, and therefore, how is your product tailored and built and positioned to serve certain needs of the customer, because this is not going to be a uniform market where you're going to be a lender where someone comes to you and they'll be able to take every type of loan for every type of need, right? I think lending um, uh, doesn't lend itself, if I may, to that kind of uniformity. So I think figuring that out and then building customer trust, right, and giving them a good experience, I think this is going to be critical to really scaling up the business over the next coming decades, and actually capitalizing on this latent opportunity, right? Because the opportunity has been there. What is now enabling it is the availability of technology. Obviously, the digital kind of India stack is a huge enabler. Just having these real time ability to kind of transfer money very quickly without much friction, that is definitely a huge enabler, and that infrastructure has to also continue to grow to support the growing volumes and the growing usage that is going to come, right? So I think from a company perspective, it's figuring out who are you serving and how are you serving them.
Yeah, right. Rohit?
Right, Nirav. So, like one thing which has been obviously said, right, it's around the opportunity on digital credit side, and I think it's interesting that while we have obviously seen so many companies starting in the last 5-6 years, still I think digital credit is less than 1% of total credit in India. US is I think at 35-40%. China is also I think not very far. So obviously there's a lot of opportunity on that front, and I think we obviously have to focus on a right niche. What value are you bringing in? And there's a huge opportunity. Second area I believe is around simplification of financial products. So people are far more aware today. So how you capitalize on it, how you build on that, and how do you simplify products within lending, of course, but I think beyond lending as well. I think that is also going to be very, very important. I think the need is more than ever. And the third part, I think, which is a hope as well, right, for the lending startups to actually build on, I think fintech and banking collaboration is going to be very, very important. Especially, I think maybe except for Mukesh, who focuses more on P2P, but for everyone else. So I think, hopefully, I think we will see a lot more co-lending partnerships and I think better collaboration happening. So that would, I think, really give us, I think wings on that side. But yeah, I think looking forward to these three areas in the near future.
Absolutely. Great. Thank you, everyone. Thank you, Mukesh, Rohit, Gaurav. It's been a complete pleasure hosting all of you today and having this discussion. And I look forward to many such more debates. Thank you.
Thank you,
Thank you.
Nirav.
Thank you, Nirav.
Thank you, Mr. Nirav Choksi, co-founder and CEO, Credible, for moderating the session. Mr. Mukesh Bubna, CEO, Monexo Fintech Private Limited. Gaurav Jalan, founder and CEO, Empocket, and Rohit Garg, co-founder and CEO, Smartcoin, for a very
Thank you.
valuable and insightful discussion on opportunities for fintechs in the post-COVID world. Now we will have a short networking break where you can visit the networking lounge, and we will resume back with our last and final panel discussion very shortly. Thank you.